Hi, this is Elliot Eisenberg, Consulting Economist to American Pacific Mortgage, catching you up to date on the latest in economics. And since the beginning of 2022, two major things have occurred. The first one is interest rates have gone up considerably on the treasuries and, of course, on mortgage-backed securities, 30-year mortgages to be precise. So late last year, there was expectations among most market participants that three things were going to happen. The labor market was going to tighten, but do it slowly. Pent-up demand was going to slowly dissipate and go away, and supply chains were going to get better. And then what happened? Data in January came early January, throughout January, and then early February, and it put the kibosh on all of that. Supply chains have already gotten worse. The demand for stuff from households actually went up, in part because of Omicron. And labor market unemployment rates fell precipitously, making the labor market much tighter and causing wages to go way up. The Fed sees this and says to itself, whoa, things have dramatically changed. And instead of raising rates, say, 3 or 4 times, we're going to have to raise rates maybe as many as 6 or 7 times. As soon as essentially word got out that the Fed was changing its thinking about inflation and what it was going to do to combat it, long-term rates instantly went up in anticipation, and that drove 30-year mortgage rates up. And then rates were meaningfully higher in a relatively short period of time. Then the second thing happened, and that's the Russian invasion of Ukraine. And that Russian invasion caused 3 things immediately to happen. First, it caused inflation to go up because the cost of energy in particular, and then on top of that, all kinds of metals like nickel and copper and aluminum. And then on top of that, food prices went up for wheat and corn and so on. So inflation goes up. The second thing that happened is GDP growth expectations for 2022 have now been depressed to some extent. So we're going to grow, but we're going to grow less. So the inflation causes the Fed to say, well, we better raise rates even more. The weaker GDP growth says, maybe we'll hold off. So those two things kind of cancel each other out. The third thing that happens, and that's most important for housing, is a flight to quality. Investors go, whoa, all kinds of uncertainty lurks with the war in Europe. We don't know how high energy prices will go. We don't know how the war will turn out, how long it will last, what other countries will do, what kind of sanctions are going to be imposed on Russia as a result. We better buy safe, secure assets, and nothing is safer and more secure than U.S. treasuries and the U.S. dollar. So folks buy the U.S. dollar, the dollar goes up in value compared to other foreign currencies. The next thing that happens is treasuries become very desirable, and that demand for treasuries pushes up the price and pushes down yields in the process. I think this is a temporary phenomenon. Once the war in Europe goes into the background, interest rates go back to where they were pre-Russian invasion of Ukraine. When that is, I don't know, but again, this is a short-term phenomenon. So I recommend that we enjoy this blip down in interest rates, encourage people to buy homes, and certainly to refi for rate and term. Millions more households now qualify than did just a few weeks ago. Before I close, I want to give you some insight into why I think the economy can withstand a rate increase. Right now, there are about 6 million unemployed Americans. There are about 11 million open jobs. If the Fed weakens the economy slightly, such that those 11 million jobs become, say, 7 or 8 million jobs, that's okay. The economy can withstand some rate increases. How many will depend on the war, how things go, how the economy does, and the Fed will do it on a piecemeal, rate by rate, increase by increase time every 6 or 8 weeks, 6 weeks when they get together. I hope this gives you some insight. Enjoy the dip in interest rates, and I look forward to seeing you next month.